Welcome to the Tech and Real Estate News Podcast, where we dive deep on recent trends within real estate and tech. I'm your host, Ariel Herrera, your fellow data scientist and real estate investor. Today, we're going to be covering 3 topics. First, don't get your hopes up for a housing market crash. Second, 5 myths about technology the real estate industry must bust. And third, house flipping spikes across US in the first quarter 2022, but profits drop. This is going to give you, these 3 topics, a good understanding of where we currently sit within the housing market, as well how technology can shake the industry up. All right, let's get started. The first news source that I came across was a video on YouTube called Don't Get Your Hopes Up for a Market Crash. And this video does a great job to actually show historical information from the 70s and 80s and explain why we shouldn't expect a housing market crash within prices. So the first reason they have here is inflationary times. Recession and stock market crashes are not indicative of a housing market crash. Plenty of recessions historically have had housing continue to go up in price, especially during high inflation, which we have right now. This occurred in the 1970s. Inflation cooled after an increase in interest rates when they were up to 10%. S&P 500 had a decrease, so the stock market fell, but housing median sales price continued to increase. And you could see here on the chart, there's a chart of median sales price between 1970 to 1980, and during that period of the stock market crash, there was still an increase within housing. The second reason why you shouldn't get your hopes up for a housing market crash are rising mortgage rates. And you might be thinking, well, rates are increasing, buyers are going to be backing out because less of them can afford a house. So of course, there's going to be less demand and ultimately more houses sitting on the inventory and prices going down. Well, the issue here is that there's already a very low supply. We are missing about 3 to 5 million homes across the US. An increase in mortgage rates will definitely wipe out buyers. Potentially 50% of buyers won't be able to afford houses. However, our supply would just go back to pre-pandemic levels. As well, interest rates are still historically low and less than the inflation rate. So right now, interest rates are around 5 to 6% if you're purchasing a property. However, inflation is at 8%. So because inflation is higher, it really just becomes irrelevant for buyers, say, who are buying with all cash, because they need to protect their cash from inflation, such as institutional investors. So they're still going to be purchasing properties regardless. This means that even though we may see traditional buyers, first-time homeowners, move-up buyers backing out of the market, I doubt we're going to see the big banks and other institutional investors back out as well. Now, the third reason to not get our hopes up for a housing market crash is because there's no fundamental crisis. Back in 2008, a big reason for the crash was because people could not afford to pay the mortgage on their properties. As well, properties were not worth the amount that they purchased the property for. There was a lot of unqualified buyers, but that's no longer the issue. We've had many regulations since to make sure that home buying is a lot more strict. As well, the video goes on to bring in some information of Texas. So in quarter 1 of 2022, Texas had a median household income increase to $110K. And what they're trying to insinuate within the video is that we're seeing those who are purchasing properties to be more white collar than blue collar and have higher paying jobs. Therefore, when a recession hits, white collar are usually the last to actually get fired and usually have higher amount of savings. So the likelihood of people losing their jobs, not being able to afford their properties, is of lower probability. Therefore, we don't expect there to be a large decrease in prices because there's no underlying issue of unqualified buyers within the housing market. The second article, 5 Myths About Technology the Real Estate Industry Must Bust, was written by Entrepreneur, and the audience was more for property managers. However, I still think it's really useful to understand what are some pain points and reasons that real estate professionals might not want to include technology. So the first myth is it's too expensive. The industry's excuse for not adopting technology is that doing so will be too expensive, considering costs of the device and installation. However, technology has significantly advanced to the point that it costs a fraction of the price to manufacture devices now than in the past. So for example, adding in sensors, that's the Internet of Things, smart locks, intercoms, all of this has become a lot more simple, sleeker, and affordable. So it really shouldn't be a barrier to start using these technologies. Myth number 2, my staff will feel replaced. And this goes wide across industries, not just for real estate, but property management itself has one of the highest employee turnover rates. People in the sector feel burnout at a faster rate than in other industries. And a major source of this burnout has to do with mundane, time-consuming tasks. So things that are very repetitive. Therefore, if you can actually implement technology and remove spending hours on these simple tasks like entering tenant information in a database, processing package deliveries, etc., you're going to allow your staff to focus on more meaningful tasks and building relationships with tenants, landlords to combat this burnout. Reason number 3, the devices are too complicated to install and use. This is irrelevant since a lot of these property management softwares are actually able to be used handheld on your phone. You don't need wired lines and such like 20 years ago. Reason number 4 to not use technology is it'll lead to easy data breaches. So with advanced technology like blockchain around the corner, the opposite is actually true. Using technology such as storing important information in the cloud is one of the best ways to safeguard it. Technologies like the blockchain ensure accurate, safe, and fast real estate transactions. The last myth here is the industry simply doesn't need technology. And the reality is completely false. As we witnessed during the pandemic, technology was our lifeline, including in real estate. For instance, technology has enabled the mass work-from-home shift, contactless deliveries and building entry, and even health screenings upon entering buildings. Simply put, now is the time for real estate to adopt technology on a larger scale. The last article here is geared towards house flipping. And Adam did a study to show that house flipping profits have decreased over the last several quarters. And this is really interesting because house flippers are a big part that drive the economy. House flippers remodel homes so that first-time home buyers can usually get their first properties at a lower cost. It also employs many people, from contractors, painters, and other hardware installers. There's also a lot of inventory that is purchased in order to do house flipping too. So the way Adam analyzed this data was to look at sales deed data to see when a property was purchased and then when it was sold within a 12-month time frame with a return of about 20 to 33%. Rick Sharga, the executive vice president of the market intelligence for Adam, stated, "The good news for fix and flippers is that demand remains strong from prospective home buyers, as evidenced by this quarter's report, which shows that 1 of every 10 homes sold during Q1 was a flip. The bad news is that rising mortgage interest rates are beginning to slow down home price appreciation rates, and buyers have become more selective and less willing to outbid other buyers for properties they're invested in. This is having a predictable impact on profit margins for investors." So I definitely agree here with Rick in that higher mortgage interest rates are going to slow down home price appreciation, making it harder for flippers. What isn't mentioned here is that a lot of flippers, when they purchase these properties all cash, they use hard money lending. So someone else is giving them a loan. And in this case, with interest rates continuously going up, it's going to be harder to make a return on that investment. So I think understanding house flipping and what the returns look like, whether you are a house flipper or not, is important to understand if they're going to continue to be a major part of the economy. If they don't, that could definitely lead to a recession. So for upcoming content, I have a 3-part series coming out, how to analyze a real estate market with Redfin data. Redfin data is free, it's available to download, and it gives some really good stats around median home sales price, median days on market, inventory year over year, and more. So I'm going to show in a 3-part series how to analyze a market with the data, than how to extract the data using Python, as the file is a little bit hard to open up since there's so many rows of data. And in the third part, we're going to use Tableau to bring it to life. And for the weekend plans, this weekend I have my mom coming down from Jersey. We have a family event. And then I'll be flying off to Portland, Oregon. Really excited to be there for the first time and looking to get some hiking in. If you haven't already, please join the Facebook group, Tech in Real Estate. That's where I'll be posting all these news articles throughout the week before releasing it on the platform. And it's a good way to ask questions about data, analytics, and real estate, not just straight to me, but to the whole community as well. Thanks so much for watching and have a great weekend.